Welcome to Cotality's Housing Market Update for March 2026, brought to you by First National Real Estate. Two months into 2026, and we're seeing housing values continue to rise, but at a slower pace and with a clear divergence in trends. The national headline of a 0.8% rise in February masks some very different trends playing out across the cities and across the regions of Australia. The larger capital cities have slowed quite sharply, while the mid-sized capitals continue to record strong rates of value growth. Home values in Sydney and Melbourne have largely flatlined since December, while the mid-sized capitals are continuing to record solid monthly growth of more than 1%. Perth remains the standout performer. In February alone, housing values in Perth rose by 2.3%, which equates to more than $22,000 being added to the median dwelling value in just 1 month. Brisbane, Adelaide, and Hobart also recorded monthly gains of more than 1%, continuing a strong growth trend across these markets. In contrast, Sydney and Melbourne have been less resilient following the February rate hike and a noticeable softening in buyer sentiment. Home values were flat over the month, and on a rolling quarterly basis, Sydney housing values are now down 0.1% and Melbourne's down 0.4%. While these cities had traditionally led the housing cycles, history shows there are periods where they move countercyclically, and that appears to be the case right now. One of the most important factors supporting growth in the mid-sized capitals continues to be extremely low housing supply. Over the 4 weeks to March 1st, Perth listings were 47% below their 5-year average. Brisbane listings were down 30%, and Adelaide listings were 22% lower. That lack of available stock is creating some urgency amongst buyers. Interestingly, advertised stock levels remain low in Sydney and Melbourne, but we're now starting to see a clear lift in the flow of new listings. Freshly advertised listings through February were up on levels a year ago and more than 8% above average in Sydney and Melbourne. This suggests that vendors are becoming more motivated, possibly trying to sell ahead of a further softening in market conditions as clearance rates ease and demand slows. If the typical seasonal pattern holds, we're expecting to see the flow of new listings to continue lifting as we head towards Easter. When we drill deeper into the data, another clear theme emerges. Affordability is driving performance. In Sydney, for example, the lower quartile of house values rose by 2.5% over the past 3 months, while upper quartile house values fell by 2%. This pattern is evident to varying degrees across most of the capital cities. There's simply much stronger competition for lower-priced properties, where first home buyers, investors, and upgraders are all competing at the same space. At higher price points, tighter serviceability constraints are limiting demand. We're seeing a similar trend across regional markets, where dwelling values are up 3.2% over the past 3 months across the combined regional areas of Australia, compared with a 1.8% rise in capital city values. Lower price points and rising internal migration continues to support demand, with growth holding firm so far. The rate of growth in Brisbane housing values held strong through February, rising 1.6% and adding approximately $17,100 to the median dwelling value. While values continue to rise rapidly, the speed has slowed a little bit from October last year, when home values were rising at a monthly pace of 2%. The unit sector has been consistently leading the growth trend, with values up 6% over the past 3 months, compared with a 4.6% rise in house values. Similarly, stronger growth conditions are evident across the lower price points, with values at the lower quartile up 6.4% in 3 months, compared with a 3.4% rise in upper quartile values. To wrap things up, Australian housing outcomes are likely to be increasingly diverse through 2026, but broadly we are expecting some upwards pressure on housing prices to lose momentum as demand-side pressures ease and supply shows a gradual rise. On one hand, we're seeing clear headwinds emerge. Affordability remains one of the biggest constraints on demand, especially after the February rate hike, further eroding borrowing power. Loan sizes are high, serviceability buffers create a higher barrier to access credit, and wages are going backwards once you adjust for inflation. At the same time, population growth has normalized, consumer sentiment has softened, and regulatory settings have become a little bit more restrictive at the margins, all of which point to more cautious behavior from buyers, particularly at the higher value end of the market. But that's only one side of the story. There are still some important tailwinds supporting housing values. Supply remains persistently tight across most markets, and while we're starting to see early signs that construction activity and new listings are lifting in some markets, advertised stock levels are still below historical averages. The labour market also remains a key stabiliser. Employment levels are high, the jobs market is tight, and that's helping to underpin income security and mortgage serviceability, which in turn reduces any risk of widespread forced selling. Targeted policy support, like the 5% deposit guarantee, is also continuing to support demand, particularly from first home buyers in more affordable segments of the market. Overall, the housing market looks finely balanced. We still see some scope for further upwards pressure on housing values, but growth is likely to moderate and become increasingly uneven. The strongest conditions are likely to remain concentrated at the lower end of the market, where competition is most concentrated and affordability thresholds are less binding. In contrast, higher price segments are likely to see softer outcomes as serviceability constraints continue to limit the depth of demand. That points to a market that's becoming increasingly segmented, with affordability and access to credit playing an increasingly important role in shaping outcomes. If we're right and the market is set to slow further, sellers will need to be realistic about their pricing expectations. For buyers, although housing affordability remains stretched, a slowdown in price growth and a pickup in listings should help to ease some of the urgency that's been apparent to different extents from region to region over the past few years. As always, you can keep up to date with all the housing trends at the Insights pages of the Cotality website.